What if I told you that I took just £25 a week, the cost of a Nandos or perhaps 4 pints of beer, and turned it into something that could change my financial future forever? No crypto gambling, no stock picking genius, and no secret insider knowledge. And hopefully no hangover. Just £25 every single week. For an entire year, I fed the beast that is the S&P 500 through market crashes, trade wars, and political chaos that had financial experts losing their minds. Today, I'm pulling back the curtain, the real numbers, the sleepless nights during market crashes, and the one simple strategy that might just be the most powerful wealth building tool that you need to understand. Now, here's something that blew my mind when I first realized. When you buy into the S&P 500, you're not just buying American stocks. You're buying a slice of companies that generate 40% of their revenue outside the US and across multiple industries. Think about it, you use an iPhone, that's Apple. You shop on Amazon, that's Amazon. You use Windows, that's Microsoft. These aren't just American companies, they're global empires. To add to those three, you're also buying a portion of all of these ones that you can see on screen also. And whilst the UK's beloved FTSE 100 delivered its best performance since 2021 at nearly 10% total returns in 2024, it was pretty lackluster versus the S&P 500's 23.3%. The S&P 500 is often quoted as a top performer, and as you can see on screen, it has seen a consecutive above 20% gain over the last 2 years. By buying an exchange traded fund, also known as an ETF, that tracks an index, you're buying multiple companies across multiple industries and thus creating diversification and significantly lowering your risk. Let me reveal the power of dollar cost averaging, or as we Brits call it, pound cost averaging, the strategy that's helped save me from myself. But first, I need to tell you about my biggest investing disaster. Back in 2021, I got caught up in the meme stock madness. AMC was everywhere. Reddit, Twitter, your mate down the pub talking about it, quoting things such as diamond hands, apes and tenders, and even my mate's nan was asking me about it. And which I must admit I did think was a little strange. I ended up getting carried away and making multiple lump sum investments throughout 2021. Totaling a whopping £30,000 invested. When AMC closed at $625 on June 2nd, 2021, I felt like a genius. But then reality hit me like a freight train. Today, AMC trades around $3.40. That is a 99.5% drop. Now that £30,000 investment I had, if I bought at the top, would be worth a mere £163. And being completely honest, my position is worth around £600, so not much better. This disaster is what taught me why proper risk management matters more than chasing gains. Working at a bank also, risk management is literally what we do every day. But I let emotion override everything I knew and got carried away. Enter dollar cost averaging. Instead of trying to time the market with large chunks, I now invest £25 every single week into the S&P 500. The same total money that I would, but over time, creating a totally different risk profile. Looking back at the last year, if I'd invested the £1,300 as a lump sum, my ups and downs could be considerably higher. Amazing if I timed it perfectly. Catastrophic if I got it wrong. Hello, AMC. Dollar cost averaging mitigates this risk by spreading your purchases across time. Here you can see the beautiful math behind dollar cost averaging. When markets crash, and they will, you're buying more shares for the same £25. When they soar, you buy fewer, but your existing ones are worth more. You literally can't lose in every scenario. As you can see on screen, these are the prices that I bought the S&P 500 throughout the last year. Sometimes I was buying above my average and therefore increasing my average position. And at other times I was buying significantly below, therefore lower my average. By spreading investments over time, my average cost per share smooths out market volatility. No more betting everything on one moment in time. But here's the real genius. Dollar cost averaging removes emotion from investing. When CNN is screaming market crash and your mates panic sell, you're thinking, great, shares are on sale this week. Studies show that 78% of retail investors underperform, and this is because they let their emotions drive their decisions. Whereas dollar cost averaging investors aren't impacted by this, and therefore they do not fall down here. The real benefit isn't just the math, it's the peace of mind. No timing pressure, no daily panic, no more AMC style disasters. Market up, great, existing shares are worth more. Market down, brilliant, I'm buying at a discount. Market sideways, perfect, I'm steadily accumulating ownership. It's the only strategy where every outcome feels like a win. After losing a significant amount of money on a meme stock, I can tell you that boring, systematic investing definitely beats gambling every time. DCA doesn't just build wealth, but it builds your confidence and lets you sleep soundly. And as you're about to see, it significantly helped my sanity over the last 12 months. The past 12 months weren't just an ordinary year for investing. They're a masterclass in global financial chaos. Let me walk you through 4 seismic events that occurred in the last 12 months. First, we've got August 2024, the great crash that wasn't. August the 5th, 2024 was named the day that nearly broke everyone's resolve. The S&P 500 fell 3% in a single day to close at 5,186, with a peak loss of 8.2% decline from mid-July highs. And the VIX, the volatility index fear gauge, hit 65, levels not seen since COVID. This was caused by a perfect storm. Japan's carry trades unwinding, recession fears based on weak jobs data, and Fed policy uncertainty. And being honest, my portfolio definitely shed money that week, but this is what DCA taught me. Those crash purchases became the best investments I had. This was also followed by a sharp recovery. By August 15th, the S&P 500 posted its best week of 2024, gaining 3.9%. Those disaster shares that I bought were worth considerably more just a few weeks later. Second, we've got November 2024, the election euphoria. November 7th, 2024 was described as a day that politics met profits. The S&P 500 surged 2.5% to an all-time high of $5,929. And the S&P 500 saw its best month of 2024 with a 5.7% gain. Also, the Dow Jones posted its largest post-election gain in 128 years. And despite polarizing headlines, the markets celebrated policy predictability. Financial stocks jumped significantly, with tech stocks leading the way. The advantage from dollar cost averaging here was that while lump sum investors were worried about timing political events, my weekly £25 captured both pre-election dips and the post-victory rallies. Third, we've got April 2025, known as Liberation Day. On April the 2nd to the 4th, Trump's tariff announcements triggered the worst 2-day crash since 2020. On April the 3rd, the S&P 500 plunged 6.65%. And then on April the 4th, saw another 5.97% drop. In just over 48 hours, 10% of the market was wiped out, equivalent of 6.6 trillion. And being completely honest, it was a bit of an unsettling time, as my portfolio was hemorrhaging, and I had friends telling me I was insane for not selling everything. But dollar cost averaging discipline kept me buying during peak fear, and I got shares at a 2023 valuation. This also caused global markets to crash, so it was scary for everyone. Fourth, we've got May 2025, known as the Great Recovery. May the 13th, 2025 was known as a day that hope returned, with the S&P 500 climbing 0.7% to turn positive for 2025. And the Nasdaq saw a recovery where it rose to 1.6% to end 0.9% positive for the year. The catalyst here was the Trump and China tariff negotiations and the cooling trade tensions. Those April disaster purchases were suddenly worth a lot more. DCA turned what was the year's worst crisis into an opportunity exactly as designed. The key learning for all this is that markets can crash violently and they also can recover just as quickly. Those who panic sold at the bottom missed the entire recovery. Dollar cost averaging buyers, they captured both the crash discounts and the recovery gains. Now let's talk about my results. Drum roll please. A healthy £21.93, which works out to be an investment return of 6.24%. Now, a quick note of this one. The investment return is a time-weighted return, as this gives a better picture of performance for portfolios where you have made more than a single contribution, as the time-weighted returns adjust for these cash flows, which for the volatile market and the crazy year we had is a fantastic result, especially as I didn't lose any money through my dollar cost averaging approach. As you can see on the chart, I did start pretty flat, but then my portfolio started to grow well. But then, as you can see, we had some big drops where my portfolio went red. But with the dollar cost averaging approach, it ended pretty level, which from a risk management approach is fantastic. In addition to this, I've set myself up well, and I've showed that if I could implement a habit like this, it could make me 716k after 40 years, with 664k of that coming from compound interest, if we're using the long-term growth rate of the S&P 500, which is around 10.13%, as you can see in these charts on screen. Let me share something that changed my entire relationship with money. £25 isn't life-changing money for most. It's lunch money. It's less than what you spend at the pub with your mates. That psychological trick, investing just beer money instead of serious money, removed the emotional charge from market crashes. When my portfolio dropped significantly, I didn't think I've lost a fortune. Actually, it didn't faze me at all, as I knew that the next purchases were even cheaper than my previous ones. I actually saw it as a sale. Behavioural studies show that DCA investors experience 41% less stress during market downturns. Why? Because each weekly investment feels insignificant, but the cumulative effect of this is so powerful. Now you know this, let me talk you through how you can get started. Step 1 is to choose your platform. Personally, I prefer Trading 212 and Invest Engine, as they are simple and commission free. Now, if you're ready to get started and you also want a free fractional share worth up to £100 when you sign up, please feel free to use my sponsored code DEAN with Trading 212. Full disclosure here, this is a sponsored code, so I do earn a small commission and terms do apply, so please read them carefully. Step 2 is to automate everything. Set up recurring investments to ensure you never miss a week. When it's effortless and requires no intervention, it's more likely that you will continue and build it as a habit. Personally, I invest via Stocks and Shares ISA, and the good news is that in the UK, you can invest up to £20,000 a year across your various ISA accounts. Step number 4, and this is a really important one, is to ignore the noise. If you can't stop looking, delete your trading apps. Don't look at financial Twitter and just check your portfolio quarterly. And most importantly, don't fall for the latest hype. Studies do show that investors who check their portfolios daily do underperform by 2.4% annually. Now, for a bit of inspiration, let me tell you about Anne Scheiber. She's a secretary who never earned more than £4,000 a year. And she started with a £21,000 investment in 1944 and never touched it. When she died at 101, her portfolio was worth a whopping £22 million. Her secret? She started early, she stayed consistent, and she let compounding work its magic. Now you know this, you have a choice. You can either be the person who panics when markets crash, or the person who sees opportunity in chaos. Equally, you can also keep making excuses about not having enough disposable cash to invest, or you can be the person that starts with what you have. If this video changed how you think about investing, please smash that like button and subscribe for more real world money strategies. And please also consider sharing this video with someone who needs to see it. The best time to start investing was 20 years ago, but the second best time is right now. Finally, if you want to learn how to live your life and build your wealth like the financial elite, watch this video here. I'm sure you will find it truly eye-opening. Until next time, ta-ra.